Bring in Tom Lee, CNBC contributor, head of research at Fundstrat Global Advisors, and, optimistic perennially about the stock market and where it might go from here. So, Tom, you think that the inflation reading that we get on Thursday could be pivotal? If prices didn't shoot higher by as much as people fear in October, you think that could be good for the market?
Hi, John. Yes. CPI has been a black hole for most of 2022 because we've had constant upside surprises. And of course, that's caused the Fed to be in a big hurry. I think Thursday's October CPI could actually be a game changer as much as August CPI, which came out in September, really soured investors. And the reason for that is, we're getting finally, I think at some point, a payback on core goods like autos. There is going to be a visible adjustment from medical insurance. And I think maybe the first signs that shelter is actually going to start slowing. So even though there's this expectation it might take 12 months, I think it's going to show up a lot sooner. And I think that there's a possibility that by year end, core could be running below 4%. And it would go a long way towards the Fed sort of having some breathing room about what they do. And I think it means a more predictable Fed. So it could be a game changer. And it means yields would start to fall in the bond market too.
So in this case, if prices aren't shooting up as much, if things like, the rents, which are too darn high, if they don't shoot that much higher, you think that might cause the Fed to ease off when it comes to interest rates. But also, when it comes to the midterms specifically, if Republicans do what it looks like they're about to do, which is certainly take one house of Congress, maybe two, you think they back off of Ukraine military aid, strengthen Russia's hand, and maybe that war is over sooner, where the economy is concerned, that has implications?
John, yeah, it's I think for a lot of reasons, markets are going to appreciate a split, Congress versus White House, meaning if Republicans control the Senate and the House and the White House, of course, stays Democratic, that's actually disinflationary. Since 1900, the inflation that's realized under that mix is typically half of compared to when you have a Democratic president and a Democratic Congress. And so that means fiscal spending's reined in. I think from a market's perspective, that takes out the inflation risk premia, which is, again, good for equity valuations. But yeah, and as a practical matter, I think it does mean that spending gets reined in, and it's possible that it might even mean, an end or some sort of resolution towards the war, which may not be popular, but, the war itself has created enormous food and inflationary pressures.
No telling what that means, though, for the world if things go that way. But what about the underlying economy? I mean, the holiday quarter right now looking iffier than any I can remember because the forecast suggests not only won't there be the spike in demand, but, with inflation doing what it is, people might actually buy fewer things even though they're spending more money on them. If that happens into next year, do we see potentially more layoffs, a spiral downward for the economy and potentially for the market?
John, that's tricky because, obviously the Fed and the stock market does want the economy to slow just so that it takes some of the pressure off the labor markets and wage inflation. So there would be some relief if what you're describing is true, as long as it's not leading to a recession dynamic. I think that's the tricky balance that, I'm on the side that I don't think there's a recession, but this is a slowdown. There's that fact that you're describing, there was a lot of over ordering and a lot of double ordering, and there's a lot of sated demand. And that means goods producers are going to have a lot of inventory, and that's prices being cut.
Right.
But that's also disinflation.
Well, you say you don't think there is a recession. Do you mean you don't think there's going to be as things stand right now, or just that it's not happening right now?
I think both, John. I know investors look at this level of Fed hikes. I mean, it's staggering, and they see the bond market, and they think there's a recession, has to be underway. But earnings have actually held up shockingly well because we have to remember companies went through, basically a near extinction event, and so they've really cut costs and been really careful about expansion. There is a shortage in the labor market, but if the labor market is tight but not overutilized, that doesn't mean you need to sort of purge a lot of labor. That's really a recession dynamic. And even housing, which is slowing, as you know, is really in the hands of much more secure buyers. You know, the average FICO score or the amount of leverage is so much lower than '08. So I think I would come out in the camp that the economy is certainly going to slow because cost of money's gone up. But remember, households have $100 trillion of cash. Well, if they're earning 4% now on that. So it's not like households are automatically getting weaker as well. So it's very mixed, but I would say a soft landing is the least expected.
Soft landing. Somebody's still counting on it. Tom Lee, thank you.